Today's high inflation rate is eating away at the value of savings accounts. With prices 8.6% higher than this time last year, any money earning less than that will lose buying power. If you're eyeing ways to fight swelling prices, Series I bonds, an inflation-protected and nearly risk-free asset, may now be even more appealing. The government's inflation protection savings bond right now is like a Birkin bag, highly coveted. With the stock market crashing and inflation rising, people are desperately looking for a place to invest. In this video, the shrewd investor will explain what these bonds are and how you can even make money in this down economy. Series I savings bonds are designed to track inflation. Known as I bonds, these are relatively stable government-backed investments, sold directly to the public. The interest rates change every 6 months but reflect the most recent inflation stats. I bonds are paying a 9.62% annual rate through October 2022, the highest yield since being introduced in 1998. This relatively unknown inflation-proof Series I savings bond has become a hit with $17.5 billion sold in the 6 months ending in May, according to the Treasury Department. That's compared with $364 million in I bond sales in all of 2020. For comparison, most savings accounts earn near 0% in interest, which gives you no reassurance in a high inflation environment. Here's how inflation is affecting your savings. The current 8.6% inflation rate is an average across goods and services. Some areas of spending may be experiencing even higher price increases. For reference, 2% inflation per year is considered healthy for the economy. The average interest rate for a savings account is 0.06%. You lose a little bit of value each year to the normal inflation rate. The trade-off is that a savings account is low risk, compared to the stock market, and easily accessible, compared to a bond or CD. But with the inflation rate currently very high, you may be better off moving money in your savings into a low-risk vehicle with better yield. I bonds, backed by the US government, don't lose value and earn monthly interest based on 2 parts. A fixed rate and a variable rate, changing every 6 months. How I bond interest works. The interest rate of I bonds is a combination of 2 rates, a fixed rate and a derivative inflation rate. The fixed rate is set by the US Treasury, which is the federal agency that issues the bonds. The fixed rate may change every 6 months. I bonds maintain the fixed rate they were issued under, for their lifetime, up to 30 years. Currently, the fixed rate for I bonds is 0%. The US Treasury applies a formula to the Consumer Price Index, and the fixed rate to calculate the total interest rate on I bonds. I bond interest rates are updated on the first business days of May and November. So how can you get a hold of these bonds? But first, if you like this video, don't forget to hit like and subscribe and comment below. How to buy I bonds? There are only 2 ways to purchase these assets: online through Treasury Direct, limited to $10,000 per calendar year for individuals, or using your federal tax refund to buy an extra $5,000 in paper I bonds. You may also buy more I bonds through businesses, trusts or estates. For example, a married couple with separate businesses may each purchase $10,000 per company, plus $10,000 each as individuals, totaling $40,000. Drawbacks of I bonds. One of the downsides of I bonds is you can't redeem them for at least 1 year. And if you cash them in within 5 years, you'll lose the previous 3 months of interest directly before your sale. You only get paid the full interest rate if you keep the bond for at least 5 years. Another possible drawback is lower future returns. The variable portion of I bond rates may adjust downward every 6 months. But, There's only a 1-year commitment with a 3-month interest penalty if you decide to cash out early. You also have to pay federal income taxes on the interest. How to get a hold of these in Demand Securities? 1. You'll need patience, a lot of it. The website says the account setup takes 10 minutes. Last month, so many people rushed to Treasury Direct to purchase the government savings bond that the website crashed. 2. Go to treasurydirect.gov. Under Account Login, click the link to open an account. If you're not sure about how to navigate the process, you can take the guided tour, which is helpful. It was also a good idea to watch the video on how to set up an account. Lots of viewers have said they had issues with setting up their account, and are still having trouble reaching a live person for help, due to the high demand. 3. To set up an account, you'll need a taxpayer identification number, such as your Social Security number. You have to have an address in the United States. You also need an email address, and are required to provide at least one working telephone number. 4. There's a section to add your bank information, which will be the account you will use to buy the bonds. This has to be a checking or savings account. Triple check this part before you hit submit, otherwise you'll regret it, and have to wait even longer. 5. You'll go through several additional steps to set up your account, including creating a password, choosing a personalized image, and selecting some security questions. Be sure to choose a strong password and security questions. 6. Once you have established your account, you'll receive an email with your Treasury Direct account number. When you log into your account for the first time, you'll get a one-time passcode sent to your email. 7. Now you can electronically buy bonds by transferring money from a checking or savings account. With inflation being so high, and the stock market going down every day, this may be one of the best, most secure ways to invest and have your money retain its value. As many analysts expect the Fed to continue its current fight with inflation, they don't see the market rebounding to its former highs in the next year. The 1-year commitment of investing your money in these bonds may not be so bad after all. If you enjoyed this video, don't forget to hit like and subscribe, and be sure to turn on bell notifications. Until next time, this has been The Shrewd Investor. Thanks for watching.